The New York Stock Exchange is closed today, Tuesday, October 28, 2025. The closing price for BigBear.ai Holdings Inc., BBAI, on the last trading day, Friday, October 25, 2025, was $7.06, which represented a noticeable uptick on high volume, closing near the high end of its Bailey range. That last session's movement, where the stock pushed through minor resistance levels, is a crucial piece of information that sets a strong expectation in the minds of many watching this name. Specifically, after a period of consolidation, seeing BigBear.ai stock print that kind of volume and close near the highs suggests a short-term momentum shift that might be missed by anyone simply glancing at the stock's year-to-date performance. This isn't just some arbitrary movement. The underlying energy, which is where we exceed that initial expectation, points directly back to a surge of defense and government-related AI announcements over the past few weeks, cementing the narrative that this is a pure-play government artificial intelligence contractor whose stock price acts as an immediate and highly sensitive barometer for sentiment in that niche. It's a very different picture than the one painted by the company's historical financials, which often create a tension between the buzz and the balance sheet that is central to how BigBear.ai trades. The general belief, particularly among retail participants who might be new to online investing or self-investing through platforms like Robinhood or SoFi Invest, is that BigBear.ai stock is a high-beta, high-volatility play on the AI sector, often seen as a smaller, more speculative alternative to a massive name like NVIDIA stock or even Palantir stock. They see the massive percentage gains from its 52-week low, a climb of well over 300%, and the sudden sharp spikes in price following any major contract announcement. This belief leads to a focus almost entirely on headline risk and contract wins, treating it more like a lottery ticket than a fundamentals-driven investment. Our deeper take, the reality that challenges this simplistic view, is that the recent stock performance is being driven not just by the announcements of contracts, but by a significant and deliberate increase in institutional accumulation, particularly from firms that specialize in quantitative and small-cap growth strategies, as revealed in the most recent 13F filings. For example, looking at the institutional activity from the most recent quarter-end data point, we saw an increase in the number of institutional owners and a substantial increase in shares held by groups like Vanguard Group Inc. and BlackRock Inc., alongside a new large position taken by Citadel Advisors LLC. These aren't retail traders making impulse buys. These are sophisticated investment groups whose detailed analysis goes far beyond the press release. They are putting capital to work based on an expectation that the company's substantial backlog, which has grown to nearly $400 million, is finally beginning its conversion cycle into recognizable revenue, and that the company's recent capital raises, while dilutive and contributing to the volatility, have shored up the balance sheet with a substantial cash reserve of close to $400 million. This accumulation suggests a belief in the long-term viability of the company's unique position in government-focused predictive analytics, creating a significant divergence from the retail narrative that only focuses on speculative price action. This is the core tension here, a speculative retail following driven by news, overlaying a calculated institutional accumulation driven by anticipated backlog-to-revenue conversion and balance sheet stability, making for a highly complex trading environment. The day-to-day stock movement for BigBear.ai stock, even on the days leading up to the market close on Friday, October 25, 2025, is a masterclass in this expectation versus reality dynamic. You'll see a gap up following a positive piece of news, like the recent deployment of their biometric system Veriscan at a major international airport to speed up and secure travel, or the partnership announcements for AI-enabled edge infrastructure for military applications. The expectation is that the stock will simply continue that sharp vertical climb. The reality is that the volume is enormous, but the daily range often closes well off its highs, indicating heavy selling pressure into the strength. This selling comes from a mix of sources: short-term traders taking profits on the volatility, and perhaps older institutional holders reducing positions or utilizing the sharp spikes for better exit points, as suggested by the observed insider selling activity, even as the stock price rallies. The volume, often exceeding 100 million shares, dwarfs the average volume, making it one of the most active small-cap names on the market, and demonstrating just how many eyes are on BigBear.ai right now. This is a very different trading picture than a mega-cap name like Tesla stock or Apple stock, which generally move on macro trends or massive product news, and it requires a different approach to risk, something users of Interactive Brokers trading or Fidelity brokerage accounts need to be keenly aware of. To understand why the institutions are starting to move, we need to quickly anchor ourselves in what BigBear.ai actually does. The company is a pure-play provider of AI-powered decision intelligence. Think of them as building the brain that processes huge, messy, and complex data streams for mission-critical operations. Their primary markets are U.S. defense and intelligence agencies, but they are expanding into commercial sectors like supply chain management and digital identity, as seen with their Veriscan biometric product. Their business model is divided into two primary segments, government and commercial. The government segment, particularly the work with the Department of Defense and intelligence communities, provides the majority of the current revenue and, crucially, the massive backlog. The contracts here are sticky and long-term, which is what the institutional money values. It's an annuity-like revenue stream that is much more stable than most people realize. The commercial segment, while smaller, offers the potential for faster, more scalable growth, which justifies the stock's AI premium valuation. The company's financial history, however, tells the story of a firm that has been spending heavily to secure these massive government contracts and build out its platform, leading to consistent net losses and negative adjusted EBITDA. The reality of the company's profitability has consistently fallen short of the speculative expectation, but the institutional accumulation signals a belief that this is about to change. The most recent earnings report, specifically the Q2 2025 results, perfectly encapsulated this tension. Revenue was down year over year, which immediately disappointed the market and reinforced the bearish narrative, creating a temporary reality check that sent the stock lower. However, the subsequent analysis focused on the reasons why revenue was down, primarily due to lower volume on certain Army programs and a revised lower revenue guidance for the full year 2025. Yet the same report detailed a massive increase in the cash balance, primarily from financing activities, and affirmed a large backlog. The market narrative, the immediate expectation, focused on the revenue miss and the loss. The deeper reality is that the company drastically improved its liquidity, which is essential for a high-growth, contract-dependent business, giving it a longer runway to execute on that backlog. This is a classic pattern in complex growth stocks. The top-line miss is the expectation, but the balance sheet improvement is the more significant reality. Furthermore, the company reported non-cash charges, including a goodwill impairment and changes in derivative liabilities, that heavily inflated the reported net loss, masking the underlying operating performance. An investor utilizing self-investing tools or an intelligent portfolio needs to be able to look past these one-time non-cash items to assess the true operating health of the business. Now, let's look forward. The immediate future outlook for BigBear.ai stock is almost entirely predicated on two things: the conversion of that immense contract backlog into realized revenue, and the upcoming third-quarter earnings report scheduled for November 10, 2025. The market expectation is simple. Another revenue beat or a clear path to profitability will send the stock soaring. Another miss will bring it back to earth. The reality is more nuanced. The key to the next report will not just be the absolute revenue number, but the gross margin trend. As the company transitions its business mix towards higher-margin software and analytics products and away from lower-margin services, a core strategic goal, we should see a steady improvement in the gross margin percentage. This is the real metric that will drive long-term institutional conviction. If the company can show that the new contract work is more software-focused, its value proposition significantly increases, which would justify a higher valuation multiple and create a reality that far exceeds the current expectation. The catalysts for the stock are clear and numerous. First, any new major contract award, particularly a large commercial deal that demonstrates customer diversification outside of the government, would be a huge boost. Second, a positive surprise on the Q3 2025 earnings report, especially on the gross margin or a narrower-than-expected adjusted EBITDA loss, would confirm the institutional thesis. Third, the broader sector momentum is an undeniable factor. We are in a high-interest environment for everything AI, which drives speculative trading in names like this, similar to the gravitational pull that helps Tesla stock or Nvidia stock when the entire tech sector is performing well. For investors who are using online investment tools like the Schwab Intelligent Portfolios or utilizing Fidelity ETFs to gain sector exposure, BigBear.ai represents a focused, high-risk, high-reward bet on defense and government AI adoption. However, the risks are just as significant, reinforcing the expectation versus reality tension. The primary risk is customer concentration. The company is highly reliant on a small number of government clients. Any unforeseen changes in government spending priorities, political shifts that affect defense budgets, or the loss of a key contract